did work in multi-unit real estate, so anything 5 units and up in a commercial building, or you're buying a rental property or multi-unit. Multi-unit world, you can get up to 85% financing. In the commercial world, 75 is the top end. Depending where your building is, it can range. In the major centers, usually you're getting 75% lending. If you're going up in some of the rural areas in New Brunswick, I've seen stuff go 50% loan to value. And it's just a whole different. Normally the amortization is shorter, the interest rate's a little more. Like today, a 5 years fixed rate on a commercial property is about 5.25. But on a residential property, if it's like a 12-unit apartment building, non-CMHC, it's just over 4.5. With CMHC, you're seeing below 4. We just quoted a deal today for 3.4% for 5 years. For $2.5 million. And then, of course, everyone knows, like the 4 units down, it works just like a residential mortgage. Same concept, except they won't let you go, the 95% financing, the 100% financing that you can on a residential mortgage. And
question for you.
Sure.
Like that, for example, that was a $2.5 million deal for 3.4%. I mean, that's really low.
Yeah, but CMHC though.
Oh, okay. So what kind of property was that then?
It was a MERV.
Okay.
Yeah. I wouldn't do the credit. We have all the banks do it differently. Some banks, they have people that just do multi-units. Sometimes they have somebody or jack of all, master of none. We try to specialize and have people that do different things, so we're not all trying to learn, like know a little bit of everything, but not really good at anything. Kind of deal. One thing is, actually a big question we get a lot is, do we need environmentals? Basically, it's $1 million and down, no. $1 million and over, yes. Okay. Do we need appraisals? An appraisal is always a yes, but until you hit the 7th unit, a 7th unit and up, if CMHC goes in and if CMHC is coming on the deal, you don't have to do an appraisal. They actually do it. And that happens a lot. People go get their appraisal. You come and say, look, I got an appraisal on a 12-unit building. We want CMHC. Oh, we're going to pay CMHC. They're going to go and do the same thing again. They're not going to deduct it. Right? So that's one thing is CMHC, if you're buying a 12-unit, anything over 7 units and up, and you're going to go CMHC, you don't need an appraisal. Because they'll do it.
What's the CMHC fees now per unit?
Well, it's for the application, $150.
Don't they charge so much per unit to insure it?
It's $150. Let's say on 10 units, you're going to pay $150 per unit, and then you pay a fee. Okay. Now, if you're going 85% financing or loan to value, it's going to be 4.75, like 4.75. But then it drops. I don't have it memorized, but it drops. Like people get, you don't need. CMHC doesn't mean you're financing 85%. You can finance 50% and get CMHC. Because what will happen is the banks will say, oh, whoa, we got CMHC mortgage, we're going to cut your interest rate. Right? And
just pay the minimum fee.
And well, if you're financing 65% or less, you pay 1.75% of the amount. So 1.75%, well, if you're saving a percent for 20 years, that adds up, right? It's actually a 2.5-3 year payback to go 85%, pay your fees. So we say if you're going to keep it for 5 years, do like a home equity line, float it. So normally you commit 1 year or 2 year or 3 year or 4 year, 5 year, 7, 10, whatever. I'm not sure why anyone would do 10, but because if you want to get out, it's expensive. Very expensive.
So, like in residential now, if you have a lock in, let's say for 3 years, you get 2 years left, you really can't port your mortgage. Somebody has to be approved and everything blocks, right? So, but
person
I'm guessing.
can assume the mortgage. What happens is
You just blend the,
a bank, any bank will do it, but I mean, banks will look at it and say, ooh, the current person I like, the new person isn't any stronger, they may not do it.
yeah,
But, you know, if the person coming in is as good or comparable to the current owner, they'll let you transfer it. But if a person has CMHC, you can transfer CMHC also. CMHC is a little less lenient than a bank. They might say, you know what, we're okay, you guys can transfer the loan, but if anything happens, we're going after the original owner, CMHC.
Oh, I
They
heard of that
may
before.
not let you transfer it. So, I mean, a person might say, you know what, I'll just stay in, I won't sell it. They might look at it and say, this person's got experience, good net worth, lots of experience. This person doesn't have experience, may think they know what they're doing, but don't. Okay, there's debt service is a big thing. It's the first thing. Like, if it doesn't debt service,
yeah.
it's not going to happen. But one of the biggest things they look at in financing is the character of the person. Right? Because none of these, anything you finance in the commercial world has nothing to do with the building.
Yeah.
Right? A special care home is worth X as a building. It's worth X with a license. And it's worth a lot more with a license. Take the license out, building's worthless. Right? So you take a special care home situation, we're financing the cash flow of the license. Don't even really pay attention to the building. You look at it and all that stuff, but really it's meaningless. It's what cash flow can that building bring in is what determines it. And it has vinyl siding, but mine's brick, it's worth more. And the rent is the same, and the expenses are the same, and they're both well maintained, they're worth the same.
Yeah.
But mine's got brick, doesn't matter.
Who wants brick?
Cap rate might change a little bit, that's what changes. A building in the right spot of town might have a lower cap than a building on this end of Lewis Street. I've seen 9s, I've seen 7.75, but Moncton is in the range of, they put 7.75 to 8.75 is what they do. It's not as easy as saying Moncton is 8, St. John is 7. It's not as easy as that. A newer building will have a little better cap rate. There is it's subjective a bit. Actually, what happens is CMHC tracks it so well that if they say it's 8.5, it's 8.5. Like this, there's no negotiating it.
What do they determine?
They do all this analysis tracking, you know, vacancy rates, market value, you know, amount of empty rooms, amount of demand. It's a lot. They do a lot of analysis on it. Like Halifax, they're in the 7s cap rates. If you go to Toronto's, well, I don't know now, but like 3-4 years ago, it was in the 6s. Now you go, you find. Because in commercial world, people sign, residential world, it's month to month leases.
Yeah.
And you've got to deal with 24 people in the 24 unit building. If you have a building, you have a single tenant or 2 tenants. Lawtons of the world, those guys do 25-year leases. People put the building up for them.
Yeah.
They sign a lease, and it's all set up. It's triple net, and it's, you know, it's this for the first 5 years, this for the next 5, this for the next 5, this for the... Well, the bank walks in, you got a lease with Lawtons. Yeah, how long? 25 years, okay. 25-year amortization. When your lease is done, the building's paid for.
99 years.
Right? So it's, those ones there, you can make money. But
What about